Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and today is Thursday, November 13th. It is 2:50 p.m. Mountain Time. And so this is another episode of Investment Friday. And guess who's back? My good friend, Brad Haines, Chief Investment Officer of Juncture Wealth Strategies. Brad, we haven't seen you for like 2 weeks. How you
I
doing?
know, I apologize. I was sick last week, pretty sick. It's flu season. And so I think a lot of people, at least around me and the different places I travel to, um, are are experiencing the beginning of the flu season. So
Yeah, you can
it
keep that away
unfortunately,
from me.
yeah. And I
I
didn't
like it.
think I didn't think anybody wanted to hear me last week anyway. So fortunately, the government was in shutdown, so not a lot of economic data was coming out. So that made it a little easier to take the week off.
Yeah, it's been a whole uh crazy week listening to the back and forth, right? And it wasn't until late last night, Wednesday, well, as of today, we're recording on Thursday, so Wednesday night, um, Trump signed something to reopen, signed a budget bill to get the government back open. So technically, today, Thursday, November 13th, things should be opening back up, right?
Yeah, I mean, it's a process, right? He signed it last night. And so the process began this morning for the government to open back up. But the federal government's a very, very large bureaucracy. So things don't happen just overnight. It's a process. One of the best areas or the most visible areas where people are going to see an easing of services is in the airports and in trying to fly wherever they're going to fly for Thanksgiving. Fortunately, with the air traffic controllers back on the job, getting paid, there's a lot more capacity at airports around the country, and so airlines will start to be able to add flights back into their schedule, which will ease a lot of the traveling pain, hopefully for the Thanksgiving, but definitely for the Christmas holidays.
Yeah, I mean that was a big concern at a lot of airports, especially seeing lines in Dallas and Houston and um, places where I mean, air traffic controllers didn't get a paycheck. They missed two, possibly three paychecks,
Yeah.
and that's hard. Most Americans, as we know, can't actually afford to miss that many paychecks, miss even one.
No, I mean it's a tough position to be in. Particularly for a job that is as stressful as being air traffic controller. It's very, very difficult. But, fortunately they're going to get their back pay. So they will go as if they never missed a paycheck. So that's a good thing.
Mhm.
So yeah, we're glad to have those individuals back at work and starting to make the country go again.
One of the things that I read, and I'm not sure if if this is even possible, but I saw someone say that we might not get some of the reporting. So when we're talking about the economic data that we've been missing, um, we might not get some of those September reports that didn't ever come out. What are we waiting on? And yeah, what information should we be getting soon?
To obtain those numbers, and we will get those numbers. The data that's very, very difficult to um, get back data for are surveys.
Mm,
Survey data where they go in and they ask a consumer, hey, what is 4 weeks ago, what did you think your future financial situation would be over the next 6 months? I don't know. It was 4 weeks ago, right?
right.
No one's going to know that. And so that survey data that asks those more qualitative questions are going to be the ones we miss out on. And there's just no way to fill in the blank. What they will do is they'll put out the November reports, and then economists will um, basically interpolate between the August, September, and November data to obtain one for October.
And so then I think the mic might have cut out just for a second when you were first responding. What data are we expecting to get coming up soon here? Are we going to see interest? Well, not interest rate, but CPI data, PCE. Like, what are we expecting?
Yeah, so we will get more likely than not, we'll get CPI data. We're going to get some PCE data coming up. If I look at my handy dandy calendar really, really quickly,
Jobs data is another big one, right? We had some big
jobs data will
announcements.
start coming back out, I believe, this week. The first thing they have to do is determine what they're actually going to put out, and that is the calendar of event. So they haven't put that out yet. So that is going to be one of the things that I'm kind of guessing. Um, we'll get the Fed balance sheet, but that's with the Fed. I'm not sure if this is actually going to occur, but I know that they're probably going to try to get the producer price index, all of those metrics out this week, um, and CPI and retail sales. So we'll see. I think that's a pretty tall order in 2 days, but we'll see if they're able to get that out. But right now, today, what the BLS, the CEA, the Bureau of Labor Statistics, the Council of Economic Advisors, and all of the economic related agencies are doing is put together a schedule of economic releases that they'll then be able to um, to execute upon. Right now, we don't have that calendar as of yet.
So, I mean, this kind of brings up what we've been talking about over the last, 46 days, on all the podcasts we've put out over that time around the shutdown, around like talking about like we don't have data necessarily for these different points. So as we as we I think I talked about this last week a little bit. The jobs numbers, right? That was a big one, because we did have a few companies come out and say they were, laying off some fairly significant numbers. And the other things that I've heard, but again, it's not through the official BLS data yet because we don't have it, is that we did still lose, up to 50,000 jobs in October. So when would is that one, you said that one's not on the schedule yet, but like that feels like a really important one for the Fed,
Yeah, so
especially for interest rates.
any of the labor market statistics, they're going to they're going to get out there and ahead of and trying to get those released as soon as possible. Because of this, we also had ADP private payrolls that came in more negatively this last release. So there are some indications that the labor market went through a little more stress. Over the last month or two. And so they're going to be, and that is, again, that's one of the major areas that Fed has responsibility for is full employment, right?
Mhm.
They want to keep stable prices, i.e., fight inflation, and two, keep full employment, i.e., don't keep unemployment down. So those are two sets of statistics that I'm sure that the federal government's going to start putting out as soon as possible. Um, so we'll have to see. We'll have to see.
Well, let's put a pin right there. We're going to come back to that as it relates to interest rates. But before we go to interest rates, I want to talk about just the kind of volatility we've seen in the market over the last couple of weeks because we were at all-time highs, right? Like we've seen some big numbers on the S&P 500, on the Dow, and then today was quite a bit negative. Like we slid. The S&P 500 was down 1.66%, or 113 points, which is quite a bit. The Dow was down 797 points, or 1.65%. So like it was a pretty negative day. What was going on with that?
Okay. So it was a pretty negative day. All right. There's lots of reasons for it. One was some tech earnings didn't come in nearly as optimistic as people wanted. Another one was interest rates. December interest rate cut. If you remember a couple months ago, we were talking, and three interest rate cuts were baked into the valuation of the equity markets at that point in time. Well, we've already had two. And now what's happening is people are saying, well, maybe not in December. The
Mm,
inflation rate is starting to come back up. Trueflation's US inflation dashboard says, inflation's about 2.5 to 2.7%, somewhere in that range. It started to increase over the past couple of weeks. So maybe we don't get that December rate cut as easily as we had anticipated earlier on. So people are now repricing equities and more risky bonds to reflect the fact that we may not have an interest rate decrease in December and the Fed might take a pause. In fact, I was just looking this up and we went from right now it's about 50-50. 50% they cut one more time in December. 50% of investors are saying no, they're not going to cut in
mm.
December. That has grown from at one point it was 95% probability that they were going to cut in December.
Wow.
So it's gone from 95 to 50. So again, that shows you the changing balance as we see as we see the economy evolve here in the beginning of the fourth quarter, the mid part of the fourth quarter, um, to see whether they need to or not. We already had dissenters in the last two meetings for the Fed saying we should have cut more, and some saying we should have cut less. So
Right.
dissent is a very unusual thing with federal open market committee meetings. And so you have to take a look at those and say, okay, which way is it leaning? Right now, it's probably leaning to a 50-50 bet whether they cut in December or not. Um, One of the things that I think could push towards a cut in December is if we get a lot of the jobs data, as you were talking about earlier, and yeah, let's say October, November have not been a great month for job creation. In fact, we lost jobs. That's probably going to lean towards more of a cut than not. Because again, that starts to take precedence over inflation. Inflation 2 to 3%, I think the Fed can live with. Um, but if you start to see unemployment start to tick up, that becomes a real problem for them.
And then with the government shutdown, what, I mean, does that filter into the jobs data? Does that affect the jobs data? Um, yeah, what happens with that? Is it
I mean, yes, it affects the jobs data because everybody was out of work. But the economists will strip out the impact of that short-term impact. You also lost it in one quarter and gained it back in one quarter, so it washes out pretty easily. But to that point, what kind of economic damage did we incur from a 45-day federal government shutdown? Just for everybody's reminder, government spending at the federal, state, and local level accounts for about 23 to 26% of the US economic growth, okay, or the US economy.
that's a lot?
So it's a lot. So when you take 45 days out of a calendar year, you decrease by that amount. And in my calculation, it decreases if they completely cut off spending for that 45 days, which they didn't. You still had state and local governments spending their money. And then the federal government didn't completely shut down spending, so they were spending a little bit. But worst case scenario, if we assume no government spending happened, that would decrease GDP by roughly 2%. So that's a kind of a big hit. Now, That said, that's a very temporary thing, and it should wash out because here in December, the second half of November and December, you're going to see a real uptick in economic activity as the government reopens and things go back to work. And so we'll have to see what kind of timing that works out with consumer spending, but it should over a longer period of time have a nominal or a minimal impact.
So when we see headlines, like we have the last couple of days forecasting negative GDP for the fourth quarter, is it because of that or is it because of other economic factors too?
Uh, it's because of both. It's because of that, which exacerbated already a weakening economy at a time. So it's basically both of those factors working in tandem to weaken economic growth. It'll be interesting to see if the second half of the quarter for the fourth quarter here is able to make up for the damage. I think it'll mitigate it, but I don't think it'll probably make up the entire amount. Simply because, you already have weakness in the job market, or at least you have a labor market that is softening to a degree that it's making the headlines both on social and mainstream media. So that's already creating a little bit of uncertainty in consumers' minds and households' minds. What if I lost my job?
Mhm.
Would I be able to replace this job? I'm not so sure. So I think that uncertainty, particularly in the lower economic classes, they're going to struggle. They're going to struggle with the higher inflation, which they already have over the past few years, and they're going to struggle with job cuts. And so it's something that we'll have to see. They typically don't make up a majority of consumer spending. Usually the mid and upper classes do. But again, we'll have to see how weakness happens. We also are starting to see auto loans become delinquent. Subprime auto loans are starting to become delinquent at a pretty high rate. You're starting to see student loans be delinquent. Credit card delinquencies are starting to go up a little bit. So nothing to be panicked about. But again, it's calling in mind and indicating that there are cracks underneath the surface of the economy that we just need to be aware of at this stage in the game, and that let's not be surprised if something happens, if we have a financial stress event. Um, that said, earnings are going quite well in the equity markets overall. um, you're seeing the artificial intelligence uh, innovation revolution, however you want to describe it, is really supporting these earnings growth going forward. And it's not just impacting the top ones. All companies are starting to benefit from this innovation, and it will help the labor productivity in the United States grow. Typically, when U.S. labor productivity grows, earnings continue to
Mhm.
grow, earnings continue to grow, stock prices continue to grow. Again, does that mean in the short term we don't have a pullback? Absolutely not. It does not say that, but it says over a longer period of time that equity prices will continue to grow, and you'll continue to have some really good returns.
Well, one of the things that was coming up for me as you were talking, I was thinking about the um, again the like the highs that we've seen recently, and then when we have a day that's down as far as it is today, here on Thursday anyway, people can get worried about that, right? Like the volatility of any downside volatility. I'm usually hearing from someone. Um, and sometimes multiple people like being concerned about just okay, are we good, is everything going to be okay? And so I wanted to put that in context also, that we've as we've been tracking the whole year, how far off are we from the ultimate highs that we've experienced this year? And when was the last time we experienced either a 5% downturn or a 10%? Like where, because we've talked about that on the podcast too, like how often we see those things. Um, we did have, earlier this year, we did have a little turnaround that we have recovered from and then some, right? We've
Yeah, I
seen a
mean,
lot of growth this year.
yeah, the April tariff liberation day of April 2nd caused a pretty large drop.
Yeah.
It didn't quite get to 20%, but it was pretty close. So I count that as a 10 to 15% corrective period. And then we've rallied back to new highs quite a bit. Um, but does that mean, and we have not had a 5% pullback since that time effectively.
Hmm.
So we're down 2.6% from the all-time high set in late October. Um, would it be, would I be surprised if we pull back 5%, maybe even 10% because we've run up so much? No. And would I be concerned that this is the end of the bear market or the bull market? No, I would not be. There are still lots of positive things about the marketplace right now. There are always going to be concerns, but this bull market is far from being over. And I think it's something that people need to reassess how much this could go higher relative to what they think about history. Um, one of the problems that people have is they think in terms of averages, and averages are great, but they do not tell you anything about what's going to happen next year, right? The average, because you always hear this, the average S&P 500 return is 10%. Great. We hardly ever hit 10%,
Right.
right? So we have we have a stair step type function in the equity market where essentially it can base out and be the same type of level for a long, long time. And then we'll go through these spurts where earnings grow significantly due to some kind of innovation or revolution or demographic change, something like that can happen to where all of a sudden earnings in the US companies take off, and that's why the equities follow suit, their market values. So we're right now in the part of that stair step function where we're taking off. And one of the main reasons is because artificial intelligence is combining itself with robotics and with other types of technologies that will enable us to keep our labor productivity growing in a positive way. That is really, really critical. And people need to understand that this can go for a very, very long time before it it pops into a bubble or it goes into a bubble and it pops. So one of the differences between having lived through the tech wreck of the late 90s, early 2000s, the difference between today and then is most of the companies today are producing cash flow.
Hmm.
Okay. Producing free cash flow. That's a really important and critical difference. In the late 90s, they weren't. They were barely having revenue and those stock prices were going up a lot because they had the internet in their name or in some part of their description. That is very, very different than we are today. Okay. You have AI companies that are going up, but it's because their revenues and their earnings are going up pretty significantly. There is an issue with circularity
Hmm.
in the AI, in some of the large AI infrastructure builders. Okay. So that is one area I'm watching very closely because that circularity happened in the late 90s as well. So whenever I see circularity between um, corporations who are buying and selling each other's services and financing one another, it 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 increases the risk that this is a getting to be a little frothy, okay, in those
Yeah.
particular companies.
And so, and to describe what that means in more practical terms, it means companies are investing in each other. So a big company investing in another big company and trading services and so it's showing on the balance sheet, oh, this is $1 billion contract, but it's literally coming from another, multi-billion dollar company and they're just trading basically,
Yeah, I mean
right?
it's like if I want to sell you my car, right? and I give you a loan for 100 grand because I'm gonna sell you the car at 100 grand. Well, technically, I just made a sale of 100 grand. I have more. I have cash, not really cash, but I have another asset of liquid cash for 100 grand. But I financed it by taking out a loan and giving it to you to finance, so you could finance the purchase. It's just circularity, and those financing and between customers and suppliers can be problematic. Sometimes they're not. A lot of times they're not, but they can be if they're very, very large in number and they get to be. And then what it does is it concentrates the industry so much in one or two or three different companies that it becomes a problem. So it's just one of those things that you want to be mindful of what you own in your portfolio and make sure you're not overexposed to those areas.
So that comes kind of full circle to the question that I wanted to ask. In this like time where again, like the Mag 7 are back in full force, right? They're a huge part of the growth that we've seen. Are we back to a place where we are highly concentrated? Um, and how do we deal with that? I mean, I was talking with a client the other day and just kind of noticing how, their small cap holdings really have not done anything because the large tech stocks, and maybe not because of, but they've really not grown in comparison to these, large tech stocks and tech adjacent still continuing to dominate. And how long can we see that disparity?
Yeah, I mean that is the million, I should say trillion-dollar
There we
question.
go.
Um, because you're right. I mean, most of the return this year is it mimics 2023 a lot in the sense that the Mag 8 basically was 100% of the return that year. And if you had anything outside of Mag 8, you underperformed the index by a lot.
Right.
And it's not a great thing. Um, Hold on just a sec. But we're experiencing that same phenomenon year to date here, where you have essentially the S&P 500 being, uh, well, I should say the top eight being more by quite a bit more than the overall index. They've driven the index they beat over the past 12 months, they beat it by 12%.
Wow.
So they're dragging it up because they are 40% of the entire index is in eight companies. So we've never been more concentrated than we are today. The, However, the earnings growth has never been more concentrated than it is today. Okay. So I want to make sure that everybody understands that just because they've gone up doesn't mean they have to come down, but because of the earnings. Now, if their earnings start to slow down, if their revenues start to slow down, that becomes a different question altogether. But right now, these eight companies have really done a great job growing their revenues and their earnings in an explosion of earnings, and they have garnered most of the return over the past couple of years. And if you didn't have a high proportion of those in there, then you kind of missed out a little bit. Not to say you missed out completely, because I don't think these stocks are over by a long shot.
And that piece, I think that's the last piece I want to end on today because I literally was just talking to someone else. We were talking a little bit about AI and about the innovation cycle itself. And so I wanted to like double click on that and just remind people about the innovation cycle, not in a you know, explain the whole thing way. I can probably look for whatever the episode number is where we went over the entire innovation cycle. We should probably do it again. We'll do that another time. But remind us where we're at. Remind us of just the main curve and where we're at kind of right now with AI.
Yeah. So in your mind's eye, if you can picture an S, okay, it's an S curve. Okay. And right now, you know how an S, it's actually, I should say it's a backward S for
Okay.
so
Not a Z though.
not a Z. No, I should say it's a normal S curve. So there's that long tail right at the bottom. And we're just about to where we're starting to come up a little bit. That's all we are. So the entire S curve, where, you know, an S curve starts off really, really, the incline is very slight. It's almost like a straight line. Then it increases, and you go into this almost straight up line. And then it kind of rounds out at the top and then goes back into almost a straight line, right? We are just barely scratching we're just barely coming up a little bit off that flat line on the left part of the S curve. We're just starting this whole thing. We're
Hmm.
just starting the whole innovation cycle. I mean, right now, I think all of us can only name two or three different ways that artificial intelligence has been helping us in our daily life. Okay. And I don't mean using it to search, use it as a search engine.
Right.
I'm not even talking about those. What I'm talking about is things we used to do manually or in other ways that artificial intelligence, whether you're using the artificial intelligence or the software product you're using is using some form of artificial intelligence to accomplish a task. Okay. And there are probably two or three different ways that you can probably name that in your current profession. That is going to change dramatically over the next 5 to 10 years. And that's where I'm telling people, look, stay focused, stay on this. This can grow exponentially. We don't even really know who the winners of artificial intelligence will be in terms of companies. We think we have a few, but if you look at the internet, and I'm going to use search providers, search engines as an example, okay? What were the most popular search engines back in the beginning of the internet?
Wasn't it Netscape?
Netscape was one, very, very good. What was another
Uh,
one?
I mean, there was Ask Jeeves.
Ask Jeeves is another great one. There was Alta Vista. There was Ask Jeeves. Ask Jeeves came a little bit later. It was a little bit more high end. You had
AOL. Does AOL
Yahoo,
count?
you had AOL, and you had Netscape. How many of those are still existing?
Oh gosh. I don't know. Does Yahoo, do any of them still exist? Does Yahoo
Yahoo.
still exist? Okay.
Okay. So that's it. Yahoo's the only one existing that still exists in a current form. You can still go on a browser in Yahoo and still browse. Okay. Now, I don't know anybody who does, but I think you still can. Okay. That's it. And those owned the internet.
Yeah.
Those owned the access, a consumer's access to the internet at one point in time. Well, look at it today. Google owns most. You have some other ones like Bing, and you have a couple of others from some other providers, but for the most part, Google kind of owns that marketplace.
Hmm.
Well, that means probably artificial intelligence is going to go down that same path where you're going to have some early people that do early successes that eventually either get purchased or get washed out because other more nimble, more strategic artificial intelligence companies come out as an application, and it makes it easier and better and more cost effective for us. And so we are just starting this whole innovation trend, and I think it's going to revolutionize the way we live and do business over the next 5 to 10 years, which is why I tell people, look, I know the market's high, but that does not mean it can't go much higher.
Hmm.
In fact, I remember in 1998, people telling me, or 97, 97, 98, and uh, Alan Greenspan gave the irrational exuberance talk where he testified in front of Congress that the market was so high that it was experiencing irrational exuberance. Okay. Was he wrong? No. In the short term, he was not wrong. But in the long term, look at where the market has been since 1996, right?
Yeah.
It's so much higher than it was back then because of these revolutions in technology. So I want to let our clients know, our centers of influence, our friends out there, stay invested, stay invested. Even if we go through some short-term bumps in the road, don't take your mind off the fact that we are just starting this innovation curve.
Mm. Such a good place to leave it for now, as far as like, okay, here is it, like the overarching, here's what we're looking at. Um, to leave it on a little bit more of an optimistic, uh, I don't know, optimistic. I lost a word. What am I trying to
Framework.
say, Brad?
You're you're allowing us to sign off with a little optimism, which sometimes is lost in the narrative in the mainstream and social media worlds.
Thank you. I appreciate that. Yes,
You're welcome.
exactly. And as always, if you have any questions, anything that you're seeing, any headlines that you're confused about, I think especially that one. That would be an awesome thing to hear. Like, what are you seeing? What headlines are coming out that you don't really understand, are making you feel concerned? Let us know. Send me a note, send me an email, send Brad an email, give us a call. We would love, love, love to talk about it. So, Brad, thank you for being here. I appreciate it. I'm glad you're feeling better. We'll see you next week.
Thank you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.